Right. So on the left-hand side, we actually have a real client's portfolio, and is that diversified? Well, it's certainly diversified across the Australian equity market. It's diversified across sectors, so we would say that that's diversified, and that would meet the criteria of diversification that is trotted out across the industry and across the media all the time. The reality is it's pretty poor portfolio construction, because if you have a look on the right-hand side, we've got a diversified portfolio that involves government bonds, listed property, international equities, Australian equities, and listed infrastructure. And what I'd say to you there is that's probably that portfolio construction is not that good either. So what we have on this slide, Rob, is 15 years of market interaction. So we've got 15 years worth of data, and what we're comparing is the performance of those that particular market against another market. And this is what Dalio at Bridgewater is talking about, diversifying well. So this calculation will be somewhere in one of Bridgewater's quant models, and what they're saying is that the brown area is positively correlated. And if we have a look down at the Pearson coefficient there on the left-hand side, and Pearson was a Scotsman, and we have in the back of this presentation an explanation of who Pearson was and what he did. So anyway, what we've done is we've mathematically compared the performance of international equities versus Australian equities. And what we can see is that Australian equities are positively correlated, and that positive correlation is strongly correlated. So that means that when international equities go up by 1, Australian equities will go up by about 0.65, and when they go down, they'll go down by the same proportion. So in effect, we're moving in unison. And one of the things that business development people trot out all the time is you should invest in global infrastructure because it'll give you some diversification. Yep, it will. And it's 0.73 positively correlated to the broader international equity market over 15 years. And what that means is that you're tracking up and down your international equities. So no client ever comes in and says, oh, geez, you've done a great job. They always come in to tell you that you've done a bad job. And they say, oh, well, this diversification over here isn't much chop. And they're actually right. And this is what Dalio is raising in his in the TV piece. And you can see at the bottom there, bonds, Australian composite bonds, which is government bonds and corporate bonds, is negatively correlated, which means that when equities are rising, bonds are probably falling, and vice versa. So there you go. We've got some negative correlation there at the bottom, and but in the main, for those clients who have got significantly overweight equity positions, which is increasingly a lot of investors and their advisors, they are strongly correlated, which is all great when it's going up, but it's pretty bad news when markets are volatile or falling. So what I've done here is I've taken 5 years of data and I've plotted that on the left-hand axis against total return, and across the bottom is standard deviation, a measure of volatility. And the red dot on the left, on the intersection of the axes, is the Morningstar multi-sector growth total return index. And that portfolio has typically market tradable assets in it. It doesn't have unlisted infrastructure, unlisted property, and it doesn't have typically a lot of exposure to metals. And you can see there that it's done, well, let's call it 9 to 10%, and it's done it's taken on about 8.5 units of risk. And you can see a whole lot of Australian equities out there to the right, which is the client's portfolio. And they have either, they have done in many cases the same as or less than what the diversified portfolio has. And they've had some companies that have done really well, and CSL being one of them. Well, CSL being the better of them, and Rio Tinto. But in the main, their portfolio has taken on a lot more risk, and it's and without knowing what balance we've got in here, its return it is not much better. So that's a clear demonstration of diversification versus portfolio construction.